Hi, everybody. This is Tony Nash. I'm the founder and CEO of Complete Intelligence. This is our QuickHit, where we talk to industry experts about issues in markets and in industries. Today, we're with Dave Mayo. Dave is the founder and CEO of FedFis, based in Texas. Dave, thanks for joining us. Really appreciate it.
Right.
Can you tell us a little bit about what FedFis is? And then I'd really love to kind of jump into how you're helping out the financial services sector.
Sure. We're a unique company in the fact that we sit as a layer above banking, what we call FI FinTech, and then FinTech. So all three pieces of that we help or affect in one way or another. From the banking side, obviously, we are a data company and a provider and intelligence. From the FI FinTech, those would be the vendors to the institutions, like their core, their mobile offering. And then FinTech, that's the new stuff, right? That's the sexy stuff that the Chime and the SoFis and those types of companies that are, it used to be alt banking, and now they're kind of joined back to banking again. So we help all of those different layers in one way or another through a data set that we have and information intelligence.
Okay, great. Dave, so with everything going on in the wake of coronavirus, there's been a lot of talk about fiscal stimulus coming out of DC and stimulus through the Fed and other things. Generally, what is the health of the banking sector from your perspective? Because back in 2008, the banking sector was the worry, right?
Right.
Is that the worry now? Is that something we should be worried about?
I think our banking industry is based on a level of faith. It always has been, right? Now, that said, this is a completely different situation. Banks are very well capitalized. Banks are not the cause of the problem. We don't have a systemic banking problem or issue. We're very, very healthy right now. So I think when you talk about a stimulus being put into the economy, the more money flows in and out, the more people spend and buy and purchase, the better things are. That's just the way the banking industry is built.
Okay, great. And so how do you see banking and fintech really helping? Obviously, we know how they help big companies with big placements and debt and these sorts of things, but how do you see them helping small and mid-sized companies with this economic kind of gulf that we have right now, right? Where there's just the economy's effectively been turned off for a period of time, which is a bit weird. So how do you see what you're doing and banks generally really helping out there on the smaller and mid-size level?
I think there's a big gap in education in our country when it comes to banking. People either, I don't like banks, or I do like banks. When they're the big banks, the big four, the B of A, Wells Fargo, Chase, Citi, and then we have community banks. Community banks are all across the country. They're the life, of our banking system. They're the heartbeat. It's actually a lower touch point for the consumer. And I think FinTech, with the dramatic decline in number of community institutions, has really opened up this opportunity for FinTech. And the reason being is it's a direct touch point. So if you were to say, I want to use my mobile device or I want to use my online to do banking without having to actually drive to an institution and deal with all their policies and all of the things that go with it, it's a faster connection point. And I think we're probably going to see a lot of that in these business loans, the PPP loans, through the stimulus plan. How do we actually execute that from the Treasury to the small business owner or to the individual that needs help?
So you think that some of these fintechs are, are they kind of non-banks? I mean, would you consider them kind of non-banks within this ecosystem? Do you think they'll be able to do this stuff faster? And I don't mean this as a negative onus onto banks. Banks are highly regulated. But do you think some of these fintechs will be able to do some of this stuff faster?
It depends on which way you look at it. Because here's the deal. So when we talked about banking, and then we talked about FI FinTech and then FinTech. So a bank is a chartered institution, and FI FinTech is a technology arm of that, like online banking, mobile banking. A FinTech is something that walks like a duck, talks like a duck, but it doesn't have a charter. It's not really a bank. So they have to partner with an existing bank's charter. So there's a bank behind every fintech company. So when you think of Chime and companies like that, there's an actual bank behind that company that's doing, the regulatory side of this to protect consumers.
Okay, great. And what are you also seeing? You guys track a lot of data around banking and real estate and consumer stuff and industry stuff. Are you seeing any data that's really talking about or raising your worries about the velocity of money, about how quickly people are spending? So are you seeing that data? And if you are, is there, if it's worrying you, when does that worry end for you? Do you see us kind of going back into, say, a quasi-normal situation within the next, say, 2 months or something?
Predicting the time future, I've never really been a big proponent of predicting the future. That's your business.
Right.
But for us, what we look at are key components. So one way to measure things right now, I think, is to look at, like if you looked at a mortgage note on a 15 or a 30, what is the spread between, what we would call in the old days prime and what the asking rate on that loan is. So you're generally looking at, above 3%. And as long as you're looking at that, that's a strong indication that there's a lot of refis going on right now, right? And so the spread is there. That's an adequate spread for banks to make money. There's a huge volume of it going on. And as long as we see that volume and people continue to go to the bank, cash their checks, direct deposit always helps, right? So when we use our debit cards, when we go out and do the things that we do, changing our mechanism of spending money, whether it's through Amazon as opposed to going to the mall, doesn't change the fact that you're still spending money. So those are all positive things, but I think the one thing that we want to keep an eye on is, volume of lending. Everyone in a situation like this is going to have a tendency to kind of clam up a little bit. And as long as that continues to flow, and one of the primary things that I'd be looking at is refis and then other lending types, auto and et cetera.
Okay. Are there any specific indicators you're looking at on the commercial side to see if people are clamming up?
I don't really see anything from that perspective. I mean, I don't think people are running out there right now at a time like this. It's fairly obvious you wouldn't want to run out and start a new construction project or something like that. So those are going to have an impact. There's no way around it. But there again, that's what stimulus is there to offset. So right now, I would say we've got a very healthy banking system. We're coming out of a very healthy economy. And so what's our time frame of a bounce back? Is it going to be a V bottom or is it going to be spread out? I think it'll be a little more spread out than a V bottom. And I think there'll probably be multiple cycles of this that go on to some degree. But starting from a really healthy position in our banking system and in our economy, this will pass. And when it does, here's the thing I think is so interesting. Unprecedented levels of stimulus. And, the old saying, you don't fight the Fed, right? So does the market go up when we have a stimulated economy? Of course it does. And with this level of pent up demand and stimulus, will there be a bounce back? Yeah, there'll be a bounce back. The question is, how huge will it be and how fast?
Right. That's great, Dave. It's a huge source of optimism. Thank you so much for that. And I really appreciate that you've taken the time to join us today. So really appreciate your time and thanks very much for all that you've shared with us today. I really appreciate it.
You bet.
Thank you.